So welcome to the channel. The name of the channel is Value Investing. So I am Elisha, and I'm a student of Warren Buffett, Peter Lynch, Ben Graham, Philip Fisher, and Charlie Munger. I learned from others as well, but those are the top four. So today I'm going to share with you my investment checklist. This is a checklist I use when I buy stocks and shares. So before I buy anything, I will go through this checklist to make sure that uh, whatever stock I'm buying fits into this criteria. So let's dive into it. Right, so those are the four that I subscribe to, but the main one there would be Warren Buffett. And obviously, Warren Buffett took his lessons from Ben Graham and Philip Fisher. I also learned quite a lot from Munger, Charlie Munger, God rest his soul. Right, so the first thing that I want to go through is valuation. So valuation is very, very important. Let's not forget that Ben Graham said when you're buying a business, when you're buying stocks, you're actually buying a piece of a business. So you'd want to do that in a value conscious way. So there's a difference between value right there and price. So price is what you pay and value is what you get. So what you want is to buy things that um, you know below their value. So if the price of a stock or a share is at say 200 and its value is 400, that's a good buy because you are getting it at a price that's lower than the actual value. So there is what we call the PE. For some of you who don't know what a PE ratio, price earnings ratio is, I've got videos or lessons on this, so you can go and check my YouTube videos on that. So I go for stocks with PEs which are low, low relative to the market or peers. So when you do this, you must be aware of you must be wary of what are known as value traps. I will explain what a value trap is later on. Before I got experience in value investing, I would go for some stocks which seemed very low in terms of their values relative to their peers. But sometimes these stocks have got problems which are inherent. They've got issues which are very hard to resolve. And then I also look at discounted cash flow. I've got an Excel sheet that calculates the discounted cash flow value of a company based on Benjamin Graham's formula. And if you follow me, you will probably you'll probably get how I go about doing this. And then with that DCF, the discounted cash flow, it has to be way above the price that I'm paying. So I have to have a margin of safety of about 30%. And this is one of the very important things that Warren Buffett and Benjamin Graham stressed on is the margin of safety. So buy um, great companies at prices that are way below their real value. So 30% for me does the trick. And then peg ratios. I go for a peg ratio of less than one, and peg, this is just price earnings over growth. So it's the price that you're paying for the growth in earnings in the next couple of years. So I go for a peg ratio of less than one, and this is, this actually means that I have more penny for my buck to say, so to say. So a value trap, you'll see that I've put AT&T and Verizon on the side there. They're, you know, good examples, in my opinion, of value trap. So a value trap is an investment that appears to be undervalued based on traditional valuation metrics. But once you go deeper, uh, they they actually lack the fundamental strength or future growth prospects to justify their current price. So investors might be drawn to these stocks because they seem like bargains, but they often turn out to be poor investments because the underlying problems are too big to be resolved, to be easily resolved, and the market prices this in, has already priced this in already. So I'm sorry, my videos are not very, you know, flawless in terms of my speaking. I want to be authentic, and this is how I'm going to be doing my videos. So I'm going to be recording all the R's and M's and R's and things like that. This is the real me. That's how I just want my videos to be. So moving on, revenues and earnings power. So before I buy a stock of any company, the revenues have to be in an upward trajectory. They have to be on an upward trend. So I don't want things that are going like that. That's a bad investment. That's a bad company because if revenues are going down, then it means that profits will also follow that revenue line. But if revenues are going up like they are doing here, that means that profit, depending on the fixed cost of the company, will also rise in the same way. So my favorite companies are companies that grow their revenues, companies like S&P Global. Those are my favorite companies. And then, as I was saying, fixed costs. So this is quite an important one because fixed costs. If a company has got a lot of fixed costs, this leads to growing operating margins, like SPGI I've mentioned. This is S&P Global. So, for example, this company will add to their top line 20%. So, 20% top line, but then in their bottom line, they'll record 50% growth in margins. So 20% in in revenues, giving them 50% growth in their operating margin. So this is actually quite good, and this can be a motor, a competitive advantage. So this is quite good. One important factor is return on equity, and return on equity has to be higher than inflation. For me, and a return on equity of about 10% is good. So return on equity has to be higher than inflation, and plus or minus 10%, give or take. So once that's achieved, I know that the price of that stock will not stray too much from what the return on earnings are doing. And Warren Buffett and Ben Graham actually stress this quite a lot. So I will check. For me, if return on equity is low, that's for me. That's a deal breaker. I will not buy a stock if the return on equity is, say, below 5%. I won't do it. And then dividends. Of late, I've been going for companies with dividends because I've actually learned or seen that these investments um, they're actually good in terms of passive income. So companies like Broadcom, Lowe's, Altria, Coca-Cola. They're quite good in that sense, and there are some things that I look at before I buy into these companies. So, does the company pay dividends? So, I'll normally go for companies that do pay dividends most of the time. Um, and I will look at whether the dividends has have been increasing with time. And on this one, I want companies that have been increasing their dividends by a CAGR of more than the inflation rate. So I will also look at whether the payout ratio is below 60%, because if companies are paying above 60%, that is not sustainable. So a dividend payout ratio is the proportion of the profits that a company is paying out in terms of their dividend. So if a company makes $1 billion profit after tax and pays out 800 million, then the payout is 80%. So that's not good because you can't sustain that for too long. Then we've got the dividend growth, which I've said should be more than inflation. So there are three categories of dividend paying companies that I have been exposed to in the not so recent past. So the first one is Dividend Aristocrats, which is companies that have 25 years of consistent dividends. And these companies are companies that have been paying dividends for 25 years, but not only paying dividends, but also increasing that dividend. And then to supplement that, there is another list called the Dividend Kings and the Dividend Champions. So these two have got companies that also have been paying a dividend, but maybe probably they are not in the S&P 500. Maybe they're in the Russell 2000 or Russell 3000. That's the small cap or mid cap um, indexes indices. So the dividend king and the dividend champion, if you do a Google search, you will get listed. But I've also got these lists on Excel sheets, and put something in the comment below if you want me to go through what dividend aristocrats, dividend kings, or dividend champions are. Just comment in the put something in the comment section, and I'll get back to you with details on that. Then I also look at financial strength. Financial strength is very important. Does the company have a debt to equity ratio of less than 1? And the lower the better, actually. Most companies that I think are good companies will have ratios of 10 to 20%. They've got huge, humongous cash balances. And also, does the company have an interest coverage ratio of more than 5 times? This is how many times a company can pay tax before running out of profits. So the higher this number, the better. Most of the companies that I'm investing in will have like 14 times, 20 times interest coverage. And then also I look at, is the company decreasing debt over time, or is it increasing debt? So I want a company to decrease debt over the long run, and this debt not to be convertible, because if that debt is convertible, that will dilute the ordinary shares or the common stock, which is not good for me because I'm investing in common stock. So I don't want that debt to be convertible. I will go, deeper into this. If you just send me a comment if you want me to explain these things in detail, and also just say what you want me to explain in the comment section. So, these companies, Apple, very strong balance sheet, Google, very strong, Microsoft, the same. So these companies, they've got, quite financially strong in terms of, their cash balances, debts, and interest. And then I also look at macroeconomic factors. So these macroeconomic factors are cyclicality of the business. I hate cyclicals, and cyclicals are stocks like cars, for example. I beg your pardon. This is not really working. So yeah, things like things like cars, for example. Other cyclicals, you have consumer cyclicals, like things that people don't buy when there's a recession or when there's a when there's a dip in the economy. So yeah, I don't like buying into cyclicals. Things like aviation, I don't want to buy into that. If you remember what happened when COVID hit, the aviation industry came to a halt, and if you were invested in there, wow, that you would be crying. So yeah, is the company a market leader? I want monopolies. If it's not a monopoly, it has to be an oligopoly. It has to be a market leader, because these companies, these behemoths, are very hard to bring down. And then is this stock not in aviation, commodity, turnaround, or telecom stock? So I hate telecoms. I've said about um, AT&T and Verizon, they're telecom stocks. So yeah, so I hate those ones. So yeah, try and avoid those ones. If I was you, I'd avoid those stocks. So yeah, aviation is also very bad, and commodity is very bad because they depend on prices, etc. I don't want to make this video too long, so I'll get a move on. Then, does the company have a moat? This is quite, quite important, and it comes from Ben Graham and Warren Buffett and Charlie Munger use this as well. Has the company been around for 20 years? So the bigger the company, well, the better. If it's small, it has to have other competitive factors and a cutting edge as well, an edge. So yeah, does the company have a competitive advantage or moat? Does it have an industry edge? Is it capital light and agile? I used to like investing in companies just because they are profitable, but sometimes a companies like Caterpillar, John Deere, they are very profitable, but they use a lot of debt because they're capital intensive. So make sure that when you buy companies, you stay away from these, because in uh, in a recession they'll get hit pretty fast. They are capital intensive, which means they have to be constantly investing in capex. They have to be constantly investing in things that will help them grow their growth. And sometimes what happens is they will actually grow their assets faster than they're growing their sales, which is a bad thing as well. So yeah, be wary of that. And then, last but not least, we've got management, and management is quite important in the sense that whatever that company is doing will rise and fall on management. And I encourage you to read a book called The Outsiders. It explains what I might try to say in the next 2 minutes. But yeah, uh, good management will buy back shares, and mind you, if a company buys back, um, if a company buys back, the more shares it buys back, the more that share price will actually go up. And yeah, so this is adding value to the shareholders. Also, honesty and trustworthiness, that's very, very, very important. Capital allocation is management just growing for the sake of growing the company. There's what we call ego based growth, where management is just acquiring, roll ups, where uh, the company is acquiring, useless ventures, which they will try and spin off again within 2 or 3 years because they've been unsuccessful. So yeah, always look out for that. I hope this will help. If this has helped you, Give the video a thumbs up. It will help me with YouTube's algorithm. And happy investing. Also remember that this is not investment advice. This is just for entertainment purposes. If you want to buy anything, do your research, do your homework, and yeah, that's it from me. So happy investing, everyone. This is Elisha checking out. Peace.